Anticipated 50% market growth in banking, supply chain, real estate, and insurance by Q4 2025, an in-depth analysis. Executive summary. As we look toward the end of 2025, significant growth is anticipated across four key industries: banking, supply chain, real estate, and insurance. This report delves into the factors contributing to an expected 50% market growth in these sectors, focusing on global competitive dynamics and emerging regulations, particularly in Asia and Europe. The insights are drawn from various analyses and surveys shedding light on macroeconomic influences, technological advancements, and regulatory changes that are shaping the future landscape. Banking sector insights. Current landscape. The banking industry is navigating a complex environment characterized by mixed economic signals. According to Deloitte, U.S. banks are preparing for a modest GDP growth forecast of 1.5% in 2025, down from 2.7% in 2024. As interest rates decline, banks must contend with high deposit costs that may suppress net interest income. However, non-interest income avenues are expected to provide some respite. Key challenges. 1. Net interest income pressure. With deposit costs projected to be elevated due to ongoing demand for liquidity, banks may see a decline in net interest income. The estimated average for 2025 is a net interest margin of around 3%, which poses a critical challenge for profitability. 2. Geopolitical uncertainties. Ongoing geopolitical tensions may further complicate banking operations, leading to cautious lending practices and increased scrutiny on risk management. Strategic focus areas. Technology modernization. Banks are prioritizing investments in technology to enhance operational efficiency. The modernization of technology infrastructure is essential for banks to become more competitive and responsive to market changes. Regulatory adaptation. The reproposal of the Basel III Endgame suggests a relaxation of capital requirements, which could improve banks' performance and competitive positioning on a global scale. Commercial real estate (CRE) outlook. Market sentiment. The CRE sector is experiencing a notable shift in sentiment, with 88% of executives anticipating revenue growth in 2025. This optimism comes after years of uncertainty driven by elevated interest rates and changing tenant behaviors. Revenue growth drivers. 1. Interest rate cuts. Anticipated cuts in interest rates are expected to alleviate refinancing risks, particularly for maturing loans. 2. Sustainability focus. There is a growing emphasis on sustainable practices, with companies investing in green buildings and energy-efficient technologies. The push for sustainability is not only a regulatory requirement but also a competitive advantage in attracting tenants. Sector challenges. Despite the optimism, concerns remain regarding high capital costs and the impact of ongoing geopolitical tensions on transaction activity. The office sector, in particular, faces challenges as remote work trends continue to influence demand. Supply chain dynamics. Growth expectations. While specific forecasts for supply chain growth are less pronounced, the integration of technology and regulatory adaptability are critical for capitalizing on market opportunities. The focus on sustainability and efficient operations is expected to drive growth across supply chain management sectors. Strategic initiatives. Technology integration. Companies are increasingly adopting AI and automation to improve supply chain efficiency and responsiveness. This modernization is crucial for navigating the complexities of global supply chains. Regulatory compliance. Emerging regulations, particularly in Asia and Europe, are prompting companies to enhance compliance measures, thus increasing operational costs but also fostering innovation. Insurance industry trends. Growth potential. The insurance sector is poised for growth, driven by technological advancements and shifting consumer expectations. However, specific details regarding the growth trajectory were not highlighted as prominently in available analyses. Key considerations. 1. Technological adoption. The insurance industry is investing in technology to streamline operations and enhance customer service. AI and data analytics are becoming integral to risk assessment and claims processing. 2. Regulatory changes. New regulations, particularly concerning data privacy and consumer protection, are shaping the insurance landscape. Companies must adapt to these changes to remain competitive. Common key points across industries. 1. Macroeconomic influences. All sectors are significantly affected by macroeconomic conditions, including inflation and interest rates, which will shape growth trajectories. 2. Technology integration. There is a consensus on the importance of modernizing technology systems and leveraging AI to enhance operational efficiency and profitability. 3. Regulatory changes. Emerging regulations, particularly in Europe and Asia, are critical in shaping competitive dynamics and operational strategies across all sectors. Differences between sources. Banking sector. Insights are heavily focused on the implications of macroeconomic shifts and regulatory changes, emphasizing a cautious yet adaptive approach. CRE sector. Reports indicate a more optimistic sentiment among executives, with expectations for growth and increased budgets for technology investments. Timeline of events. 1. 2023. High inflation and interest rates create challenges for banks and the CRE sector. 2. 2024. Anticipated GDP growth leads to a reduction in inflation and interest rates, prompting strategic shifts. 3. Q4 2025. Expected market growth of 50% across sectors, propelled by technological integration and favorable regulatory conditions. Conclusion. The anticipated 50% growth across the banking supply chain, real estate, and insurance sectors by Q4 2025 underscores the importance of strategic adaptation to macroeconomic challenges, technological advancements, and regulatory changes. While the outlook remains cautiously optimistic, organizations must be proactive in navigating the evolving landscape to capitalize on emerging opportunities and drive sustainable growth. The interplay of these factors will ultimately define the competitive dynamics in these industries, making it imperative for stakeholders to stay informed and agile in their strategic planning. Counterintuitive insights on market growth in banking, supply chain, real estate, and insurance. 1. Banking sector's mixed outlook amid growth. Despite the overall anticipated 50% market growth across various sectors, the banking industry faces a mixed outlook. This juxtaposition is counterintuitive, as one might expect all sectors to uniformly benefit from economic recovery and technology advancements. Instead, U.S. banks are predicted to struggle with declining net interest income due to high deposit costs. The expectation of a slowing GDP growth projected at 1.5% and declining interest rates adds to this paradox, indicating that while the market as a whole may grow, individual banks may not see corresponding growth and profitability. 2. Commercial real estate's optimism amid high interest rates. The CRE sector is experiencing renewed optimism, with 88% of executives expecting revenue growth despite ongoing challenges like elevated interest rates and refinancing risks. This optimism, particularly in a high-cost borrowing environment, is surprising. Typically, one would expect a direct correlation between high interest rates and negative sentiment in real estate. However, executives seem to believe that the potential for economic recovery and technological investments can offset these challenges. 3. Supply chain growth. Despite challenges, the anticipated growth in the supply chain sector is linked to technology integration and regulatory adaptability, which seems counterintuitive considering the complexities and disruptions faced in the global supply chain. While many industries are still grappling with the aftereffects of pandemic-related disruptions, the focus on sustainability and efficient operations is expected to drive growth, highlighting a shift in perspective that sees potential in adversity. 4. Insurance industry's understated growth potential. While the other sectors are highlighted for their growth trajectories, the insurance sector's potential for growth is somewhat understated. This could be seen as counterintuitive given the increasing complexities of risk management and the role of technology in this space. The insurance sector is often perceived as stagnant, yet the integration of advanced technologies and regulatory adaptations could lead to significant growth opportunities. 5. Regulatory changes as growth catalysts. The anticipated regulatory changes, particularly the Basel III Endgame reproposal, suggest a reduction in capital requirements. This is counterintuitive because regulation is often seen as a hindrance to growth. In this case, the easing of capital requirements may actually empower banks to engage in more lending and investment, contradicting the traditional view that regulations stifle growth. 6. Is technological investment versus cost management. It may seem paradoxical that banks are investing heavily in technology modernization while simultaneously trying to manage costs. The expectation is that these investments will ultimately lead to cost reductions and improved efficiencies, but the immediate increase in operational expenses contradicts the typical narrative that cost-cutting measures must come before growth initiatives. 7. Sustainability efforts driving financial viability. In the commercial real estate sector, the push for sustainability is often viewed as a cost burden. However, the insight that deep energy retrofits and sustainable practices can enhance financial viability presents a counterintuitive perspective. This suggests that rather than being a financial drain, sustainability initiatives can lead to significant long-term savings and increased property values. 8. Consumer debt versus banking profitability. The expectation that consumer debt levels will continue to rise while banking profitability may decline seems contradictory. High consumer debt typically leads to increased borrowing costs and potential defaults, which would adversely affect banks. Yet the narrative suggests that banks could benefit from higher non-interest income streams, challenging the conventional view that higher consumer debt is inherently harmful to banking profitability. 9. Emerging talent gaps amidst optimism. The anticipated growth in various sectors contrasts sharply with the looming talent gap, particularly in the real estate and banking industries. It is counterintuitive that sectors expecting significant growth are simultaneously struggling to attract and retain talent. This indicates a disconnect between market potential and organizational readiness to capitalize on that potential, raising questions about the sustainability of the expected growth. 10. AI integration versus legacy systems. The push towards AI and technology modernization in banking while being hampered by legacy systems presents a counterintuitive scenario. The expectation is that these technological advancements will simplify operations and enhance profitability, yet the existing clunky systems could delay or complicate these benefits. In conclusion, the anticipated market growth of 50% across the banking supply chain, real estate and insurance industries by Q4 2025 is laced with counterintuitive insights. Various sectors exhibit optimism amidst challenges. Regulatory changes could spur growth rather than inhibit it, and technological investments are seen as both a burden and a pathway to future profitability. The landscape is complex, where traditional assumptions about market dynamics are continually challenged by emerging realities. The report on the anticipated 50% market growth in the banking supply chain, real estate and insurance industries by Q4 2025 presents several key insights, many of which may be overlooked yet are significant for stakeholders in these sectors. 1. Macroeconomic influences on banking. A crucial yet often overlooked point in the banking sector analysis is the impact of the Basel III Endgame reproposal. The report indicates that while the proposal suggests a reduction in capital requirements, this change is not finalized. The implications of these adjustments could be profound, as they may ease the regulatory burden on banks, allowing them to optimize their capital structure and potentially engage in more aggressive lending practices. This is significant as it could lead to a more competitive landscape where banks are better positioned to leverage their capital for growth, especially in a low-growth environment. 2. Commercial real estate CRE recovery signals. In the CRE outlook, the report highlights a shift in sentiment among executives, with 88% expecting revenue growth in 2025, up from a significant majority expecting declines in previous years. This optimism is attributed to anticipated cuts in interest rates and a stabilization of the economic environment. However, the potential wall of loan maturities due to refinancing risks remains a critical issue which could catch many off guard. The upcoming wave of maturing loans, particularly in the US and Asia Pacific, is a risk factor that could lead to financial distress if not managed properly. This underscores the importance of proactive financial and operational strategies for real estate investors. 3. Supply chain and technology integration. While the supply chain insights are less detailed, the implication that technology and sustainability will drive growth should not be underestimated. The emphasis on integrating technology to enhance operational efficiencies is a key takeaway that can significantly influence competitiveness. Companies that can adapt their supply chain management to include advanced technologies will likely outperform their peers, making it essential for stakeholders to prioritize investment in digital solutions and sustainable practices. 4. Insurance sector growth. The report notes that the insurance sector is expected to grow but lacks specific metrics or timelines, which could lead to a perception that the sector is less dynamic than banking or real estate. However, the significance lies in the potential for technological advancements, like AI and data analytics, to reshape the insurance landscape. Insurers that adopt these technologies could revolutionize customer engagement and risk management, leading to enhanced profitability and market share that may not be immediately visible in current metrics. 5. Sustainability and investment in technology. Across all sectors, the focus on sustainability and technology integration is a recurring theme. The report suggests that companies prioritizing sustainable practices and technology investments will be better positioned to capitalize on market opportunities. The significance of this trend is twofold. It aligns with global regulatory shifts towards sustainability and reflects changing consumer preferences for environmentally responsible business practices. Stakeholders must recognize that failure to adapt to these trends could result in lost competitive advantage and market share. 6. Regulatory changes and competitive dynamics. The evolving regulatory landscape, particularly in Asia and Europe, is a critical factor affecting all sectors. The report indicates that regulatory changes, including those stemming from Basel III and other local regulations, could significantly influence competitive dynamics. Companies that proactively engage with regulatory changes, rather than reactively adapting, will likely find themselves ahead of competitors who are slower to adjust. Understanding these dynamics is vital for strategic planning and ensuring compliance while also leveraging potential advantages. 7. Technology modernization and AI. A significant point highlighted in the banking and insurance sectors is the ongoing push for technology modernization and the integration of AI. While many banks are aware of the need to modernize, the report suggests that only a fraction are well prepared to leverage generative AI and other advanced technologies. This presents an opportunity for those willing to invest in their technological infrastructure to capitalize on efficiencies and enhanced customer experiences. The long-term benefits of becoming an AI-powered organization can be transformative, yet many firms may underestimate the resources required to achieve this. 8. Cultural shifts in workforce dynamics. The report also touches upon the importance of workforce dynamics, particularly in real estate, where an impending retirement cliff poses a threat to knowledge retention and operational continuity. As younger generations place higher value on work-life balance, sustainability, and corporate ethics, organizations must adapt their cultures to attract and retain talent. Failure to do so could lead to a skills gap that hampers innovation and competitiveness. Conclusion. In summary, while the anticipated 50% market growth across banking, supply chain, real estate, and insurance sectors by Q4 2025 is promising, the underlying dynamics reveal critical factors that stakeholders often overlook. From regulatory changes and loan maturity risks to the importance of technological integration and sustainability, these elements will significantly shape the competitive landscape. Companies that recognize and proactively address these factors will position themselves more favorably in a rapidly evolving market environment. Therefore, strategic foresight, investment in technology, and a commitment to sustainable practices will be essential for navigating the challenges and opportunities that lie ahead. The anticipated 50% market growth in the banking supply chain, real estate, and insurance industries by Q4 2025 is underpinned by several critical dynamics. For a comprehensive analysis and discussion, here are 4 key points that merit in-depth exploration. 1. Macroeconomic influences and their impact on growth trajectories. Understanding the macroeconomic environment is vital as it plays a pivotal role in shaping the growth trajectories of the banking supply chain, real estate, and insurance sectors. The projected deceleration of GDP growth, particularly in the U.S., estimated at 1.5% in 2025 alongside declining interest rates, suggests a mixed outlook. The interconnectedness of inflation, consumer spending, and investment activities will influence how these sectors adapt. For instance, as inflation moderates, central banks may lower rates, potentially stimulating borrowing and investment. However, the risk of elevated consumer debt levels and geopolitical uncertainties poses significant challenges. Discussions can focus on how these macroeconomic shifts affect each sector differently, with banking facing pressures on net interest income due to high deposit costs, while real estate may benefit from lower refinancing risks. Analyzing historical data and trends can help predict how similar macroeconomic conditions have influenced sector growth in the past, which can provide valuable insights for future strategies. 2. Technological integration as a catalyst for growth. The integration of technology, particularly advancements in artificial intelligence, AI, and data analytics, is emerging as a key driver for enhancing operational efficiency across all 4 sectors. In banking, technology modernization is crucial for managing costs and improving service delivery. For the real estate sector, AI is being utilized to optimize property management and enhance customer experiences, indicating a shift towards more data-driven decision-making. The conversation can delve into specific technologies that are transforming these industries, such as predictive analytics and supply chain management to forecast demand and optimize inventory levels, for the use of AI in underwriting processes within insurance. Furthermore, exploring case studies of organizations that have successfully implemented these technologies can provide tangible examples of the benefits and challenges associated with digital transformation. 3. Regulatory changes and competitive dynamics. The evolving regulatory landscape, particularly in the context of Basel III reforms and emerging regulations in Asia and Europe, will significantly influence competitive dynamics across sectors. For banks, reduced capital requirements may enhance competitiveness, allowing for greater flexibility in lending practices. In contrast, insurance companies may face stringent regulations aimed at improving consumer protection and transparency. A thorough discussion can focus on how these regulatory changes will shape the strategic priorities of organizations within these sectors. For instance, banks may need to recalibrate their business models to align with new capital frameworks, while real estate firms might need to adopt sustainability practices in response to regulatory pressures. Additionally, analyzing how companies can strategically position themselves in response to these regulations offers insights into long-term planning and risk management. 4. Sector-specific growth opportunities and challenges. Each industry presents unique growth opportunities and challenges that need to be addressed. For the banking sector, the key challenge lies in maintaining profitability amidst declining interest incomes and rising operational costs. The insurance industry, meanwhile, must navigate the complexities of emerging technologies while ensuring compliance with evolving regulations. In real estate, the shift towards sustainable practices is becoming increasingly important as investors and regulators prioritize climate resilience. This presents both an opportunity for growth in green investments and a challenge in terms of retrofitting existing properties. Supply chain management also faces challenges related to sustainability, with companies needing to balance efficiency with ecological responsibility. Discussions can revolve around identifying specific trends within each sector, such as the growth of proptech in real estate or the rise of insurtech in the insurance industry. Evaluating how these trends create both opportunities and risks will provide a nuanced perspective on the anticipated growth by 2025. Conclusion: the anticipated 50% market growth across banking, supply chain, real estate, and insurance industries by Q4 2025 will be influenced by a complex interplay of macroeconomic conditions, technological advancements, regulatory changes, and sector-specific dynamics. Engaging in an in-depth analysis of these 4 key points will facilitate a comprehensive understanding of how organizations can strategically navigate the evolving landscape and harness growth opportunities while mitigating potential risks. 1. The 2008 financial crisis. The global financial crisis that began in 2007 and peaked in 2008 exemplified the dramatic impact of macroeconomic factors on the banking sector. Triggered by high-risk mortgage lending practices and the collapse of mortgage-backed securities, the crisis led to severe disruptions in financial markets, substantial failures of financial institutions, and widespread recession. Regulatory responses followed, including the Dodd-Frank Act in the U.S., which aimed to improve financial stability and consumer protection. 2. The dot-com bubble. The late 1990s saw an explosive growth in technology companies, particularly internet-based firms, leading to inflated stock prices, a phenomenon known as the dot-com bubble. When the bubble burst in 2000, it resulted in significant losses for investors and a recession. The aftermath prompted regulatory reviews and led to the Sarbanes-Oxley Act, aimed at increasing transparency in financial reporting and corporate governance. 3. The Asian financial crisis 1997 to 1998. This crisis began in Thailand and quickly spread to neighboring countries including Indonesia, Malaysia, and South Korea. It was characterized by currency devaluations, stock market declines, and a sharp increase in private sector debt. The crisis prompted widespread economic reform and regulatory changes in affected countries, focusing on financial transparency, risk management, and the importance of foreign investment regulations. These historical cases illustrate how macroeconomic dynamics and regulatory responses can significantly impact financial sectors, resembling the anticipated growth and regulatory shifts in banking, supply chain, real estate, and insurance industries by Q4 2025. Future outlook. Predicted 50% market growth in banking, supply chain, real estate, and insurance by Q4 2025. 1. Banking sector predictions. By Q4 2025, the banking industry is expected to undergo significant transformations driven by macroeconomic shifts, technology integration, and regulatory changes. The anticipated deceleration in GDP growth to approximately 1.5% will challenge banks to operate in a low-growth environment. However, the proposed Basel III endgame reproposal, which suggests lower capital requirements, may enhance profitability and competitive positioning globally. As interest rates decline, banks are predicted to see an uptick in loan demand, particularly in mortgages, while focusing heavily on technology modernization and non-interest income streams to mitigate pressures on net interest income. 2. Commercial real estate CRE insights. The CRE sector appears poised for recovery, with 88% of executives anticipating revenue growth in 2025. As interest rates stabilize and potentially decrease, refinancing risks are expected to diminish, encouraging investments in sustainable and technologically advanced properties. The emphasis on AI and sustainability will drive operational efficiency and market opportunities. However, concerns about elevated interest rates and credit availability will persist, particularly affecting the office and retail segments. 3. Supply chain dynamics. The supply chain industry is projected to benefit from increased technological integration and a focus on sustainability. As companies continue to adapt to the evolving regulatory landscape, particularly in Asia and Europe, the emphasis on efficiency and resilience will spur growth. Innovations such as AI-driven analytics and automation are expected to enhance operational efficiencies, helping companies navigate fluctuations in demand and geopolitical challenges. 4. Insurance industry trends. The insurance sector is likely to experience significant growth due to advancements in technology and favorable regulatory conditions. Insurers will increasingly adopt AI and data analytics to enhance risk assessment and customer service. As regulatory frameworks evolve, particularly in Europe and Asia, insurance companies will need to adapt their strategies to remain competitive. Focusing on personalized products and improved customer engagement. Key trends influencing market growth. Macroeconomic influences. Interest rate dynamics. As central banks globally are anticipated to lower interest rates, market liquidity will improve, facilitating investment across sectors. Inflation control. With inflation rates expected to stabilize, consumer spending and business investments could rebound, positively impacting all four industries. Technology integration. AI and automation. Industries will increasingly leverage AI to streamline operations, enhance customer experiences, and gain competitive advantages. Investment in technology will be critical for operational efficiency and adapting to changing consumer demands. Data management and analytics. Enhanced data capabilities will empower companies to make informed decisions, refine risk management strategies, and personalize offerings. Regulatory changes. Evolving regulatory landscape. New regulations, particularly in banking and insurance, will shape competitive dynamics. Companies must remain agile and adaptable to comply with changing standards, particularly in Europe and Asia. Sustainability regulations. Growing emphasis on sustainability across sectors will necessitate investments in environmentally friendly practices and technologies. Strategic considerations for growth. 1. Focus on non-interest income. Banks should diversify their revenue streams through innovative products and services, particularly in the retail banking and wealth management sectors. 2. Sustainability investments. Real estate and supply chain companies must prioritize sustainable practices to meet regulatory requirements and consumer expectations, which could also enhance long-term profitability. 3. Technological adoption. Rapid adoption of AI, particularly generative AI, will be crucial for companies to enhance productivity, automate processes, and improve decision-making capabilities. 4. Cross-sector collaboration. Organizations across banking, insurance, supply chain, and real estate should explore partnerships to leverage shared technologies and best practices for mutual growth. Conclusion. The anticipated 50% market growth across the banking, supply chain, real estate, and insurance industries by Q4 2025 is underpinned by favorable macroeconomic conditions, technological advancements, and evolving regulatory landscapes. Companies that proactively adapt to these changes and invest in innovation and sustainability are likely to thrive in this dynamic environment. The outlook remains cautiously optimistic, with strategic foresight playing a pivotal role in navigating the complexities of future growth.